It's interesting. I sort of get up every day at 2:30 a.m. and the first thing that I do is obviously check what price NVIDIA is and check where we are in the frenzy mode of our lives. These are long-term investors. They don't do anything so scurrilous as check the price of NVIDIA every morning. But Kim and Edwin, welcome. There does seem to be a bit of a frenzy in public markets and a distinct sense of angst in the private markets. How much comfort do you have leaning into private markets? Ladies first. Kim, good morning.
Good morning. Thank you. It's a pleasure to be here. I think that despite what's happening, as long-term investors, you sort of look through this moment to the opportunity set over the long term. And I think if you just focus on the U.S. markets right now, we used to have 8,000 stocks in the public market, and now we're down to 4,500 stocks in the market. And I think it's something like 87% of companies with sales over $100 million are private. So I think it would be impossible for us to ignore private markets and not think that there's a large opportunity set. I think that the way we think about investing in private markets and the way we approach it is different than you might have done in public markets. I often say, we joked about it, that public markets is dating and private markets is getting married. And so you have to approach it and you have to do it very differently. You have to be thoughtful about these relationships because, for sure, if it doesn't work out, you have kids together and you have to figure out how to manage those relationships. And so I think that being thoughtful about how we engage in the private markets is increasingly a pressure among private investors, especially now that interest rates have gone up. I've been in this business long enough that these rates don't feel so high to me, but it does feel extremely high to my team. And so trying to pay attention to how the valuations have to reset before, once again, we can make a lot of money. But I have high hopes that we will continue to make a lot of money in the private markets.
Yeah, I think maybe when I got my first mortgage, it was 1994. And that was like at 5.5% in the UK. But my brother was even more tortured at 15%. Hopefully we don't go back there. Good morning to you, Edwin. Are you dating or committed? Where are you in public versus private markets?
No, very interesting question. When we think about public versus private markets, the first question for me is, do you get any kind of diversification by going into private markets, diversification benefit? And for most private assets, we think they load on generally the same kind of factors that public assets load on. So if you think of private equity to us is like levered small cap. If that's true, then you're really not getting a diversification benefit. You have to look to something else, and that something else has traditionally been alpha. And you can think about all the different sources of generating alpha from private markets, whether it's origination networks or value creation plans or just the ability to kind of pick better securities through access to private markets. And we think there's still a positive expectation in terms of the comparative advantages that we've built up to invest in private markets that gives us an impetus to push into the asset class. But I think there's one really interesting feature that's going on right now, and obviously you alluded to the start, is kind of NVIDIA and what's going on with NVIDIA. To the extent you're diversifying into private markets, you're getting away from public markets, you're getting away through the ability to access some of those huge growth engines like NVIDIA. And the one thing we've been challenging ourselves lately is, could you predict that this was going to happen? Or how would you protect yourself against this happening if you didn't have that kind of exposure? Generally, concentration in a market, in a portfolio, of course, is really bad. But there's also this big kind of winner-take-all theme going through the markets right now. Does that persist? Do you think the conditions exist right now that can kind of feed off itself?
Well, that winner-takes-all narrative, I mean, am I correct in assuming that winner-takes-all comes down to the great AI, sort of the banner? If you stick AI on the side of it, suddenly it has a new narrative. I mean, to that extent, Kim, how do you think about AI? Because various people are sort of saying that we're in the foothills of development of what AI is. We don't really understand the full potential, the implementation process, nor indeed the cost. It's a big, big subject. But what does it mean to you?
Yeah, I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry, and so there is a winner-take-all element to that, and which don't. And it seems to me that things like chips, things like infrastructure and systems has a little bit of that, because NVIDIA is so far ahead. It's expensive to catch up. There's, the technology that it requires to build these chips are sort of based in Taiwan, and we talked about the risk of that and the global risk of so much being based in Taiwan. But what we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like, it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner-take-all in that space. You're going to have to earn that spot, whereas it'll be fun to watch what happens. And I think there's going to be a lot of money burned in the process, because somebody will develop something and a fast follower will come along and make it better and cheaper, because data gets cheaper and more pervasive, and it's going to be easy for new players to come in and do interesting things. So I think we wait and we see. But that's exactly why it'll
But does it force a sense of, I mean, as you say, you look across it, you see there's certain moats around some organizations and some companies, NVIDIA being one of them, is the theory. But does it force a sense of FOMO, even though you say to me, I am a long-term investor, we're structural, we look for public and private markets. I mean, we look at these moves and we look at the scale of some of these individual names, and it does force a sense of, I hope that pension fund of mine has a little bit more NVIDIA in it relative to everything else on the longer term. Does it invoke a sense of FOMO in you? What does it do to your thinking?
At a behavioral science level, yeah, absolutely, it's a sense of FOMO. I think it's tough to deny that. I think the challenge, the way I've presented it to our people internally is, can we learn anything from it? Are there any signposts or any guides that would have indicated that, hey, this was going to happen, that you could have positioned yourself for it, that you could have anticipated it? Mm-hmm. Does it force a rethinking of something like a private-public split?
Yeah.
Where you're going to allocate capital. It absolutely kills me that a relatively naive portfolio, if you just invested your money in the public markets on an index weight basis and did a 65-35 split between equities and bonds, it probably beat most of the more sophisticated portfolios that you could have designed over the last 10 or 15 years. There was a great article in the Wall Street Journal, I think it was a week ago, talking about the bear market and diversification. And diversification is something I truly believe in, and yet most pushes into diversified portfolios over the last 20 years have underperformed.
Very quickly before we go to the poll, I want to involve the audience here. Every morning at 5 a.m. you will hear me say it's going to be the year of the bond soon. In theory, that is coming. Very quickly, to what extent do bonds now play a smart role, an additional role for you in allocation? If you briefly answer that, and then we'll ask the poll question. Kim.
I think for a long time we weren't receiving a return on bonds that was sufficient, and so people were shying away and going into more risky strategies because the payout that we had to make didn't change. We were sort of locked in somewhere between a 5% and a 7% payout for most people in the U.S. in the foundation and endowment space, and so we weren't doing bonds. Interest rates obviously are up a lot, and you can do a lot more. And I think that particularly now, there's a lot of challenges around liquidity because the private markets are not distributing anything, and so people want to find ways to get more liquid. So I think for sure there's just greater interest in figuring out how bonds can play a different role. But we also know that it doesn't provide the diversification benefit it used to provide. It used to be negatively correlated with the equity markets, and now it's just low correlation to the equity markets. And so we have to think about that a little differently as well.
Edwin, I know it's sort of a short squeeze to try and sort of force either people like you to answer this and the role of bonds within a portfolio, but has it shifted? Because it has been a fairly tough 3 years in that space, and now we worry about fiscal probity going into 2025, and that challenges long-term duration, doesn't it?
Kim kind of alluded to the problem. I think there's two classes of investors. There's investors that are return-oriented, and there's investors that are risk-oriented. And certainly for a return-oriented investor, a lot of the period over the last 10 years, bonds weren't attractive because of the low yields. We're a risk-oriented investor in the sense that we target a level of risk and we try to maximize return of that level of risk. So for us, the key question, and again, Kim alluded to it, was Are bonds diversified equities, or are they positively correlated to equities? And certainly our thinking there has shifted. I can go into technical reasons, but over the last couple of years, we think bonds have lost a bit of that diversifying property, so our appetite is probably down a little from where it was. But we still think, like, on a longer-term time horizon, that bonds can be an effective diversifier of equities, so they do play a part in portfolio construction, maybe just not as big a part as they've played in the past.
So I'm on the phone afterwards straight away for some 5 years and a little bit more NVIDIA. Let's ask the poll question now. Sorry, I front run myself. For you, the audience, here's the results. We asked you, what's the best opportunity set at the moment? And the options were traditional assets, bonds and stocks, alternative infrastructure, private credit, international markets, 29%. And nowhere, I'm keeping the money in cash. Well, that's good news for the asset management and the global investment community. You're deploying and they will earn. Alternatives and infrastructure, private debt and real estate. It's a broad church up there within those alternatives at 35%. But let's just deal with some of that, because within that, we have this debate between private equity, which has got a lot of assets in it, and it's finding it tough to find the exit point. That's using perhaps some private credit to help them with the payouts, and some people are saying that's a hidden issue for us, and it's a growing issue. Kim, for you, the blockage to entry for private equity, how much of a challenge is that for endowments like you?
So I think it's been traditionally foundations and endowments particularly have had a huge allocation to privates, not just private equity and real estate, but also venture. And that has been a huge whipsawing, both with extraordinarily good performance and then extraordinarily poor performance. And I think, but more importantly, it's locked up liquidity. Yeah. And it's made it, and now it's put more pressure on your marketables book to produce the payout that you need each year, right? So, you think about a 5% payout, but if 50% of your book is not generating anything, that means it's a 10% payout for your liquid part of your book. And you have to think about it that way. I think so. As a result, people are trying to figure out how to make sure that their privates book are not negative cash flow, right? And so they have to put cash generating assets in their private book. So private debt became very attractive. Obviously, with yields up, it gave more opportunity for people to generate a return. I think there are lots of skillful players. There's a lot of capital in that space. The story will be yet to be told. Everybody's waiting for the dislocation that will make that a phenomenal asset class instead of a good asset class and reward you for the risk that you're taking, yes. Which that's the question. Are you being rewarded for the risk you're taking? Because we think about it in terms of risk as well. It's not clear.
Edwin, is that reward challenged? I mean, are you worried about this blockage in private equity? I mean, some tech exits are happening, but it is a tough world at the moment to get these exits. There's trapped capital, I understand, of over $3.2 trillion in private equity.
Again, we kind of think about it on a longer-term time horizon, not a kind of tactical horizon. And for us, the key thing is if you have an appetite for private assets and it's, say, conditional upon being able to generate some alpha, then how much of your portfolio can you allocate to privates? So we kind of start there and we say, how much of our portfolio do you want in privates? That's driven by liquidity, as Kim suggests. You have to think about what your needs of your demands for liquidity are. If you're an endowment, you have a certain payout ratio. We're in a lucky position that we don't have demands for liquidity except over a very long time horizon. So for us, it's more around things like being able to meet margin calls, being able to rebalance our portfolio, being able to hold dry powder in case there's really interesting opportunities. So we kind of turn it on its head and say, how big can that private portfolio be? For us, it's kind of like 3/4 to 4/5 of our portfolio. And then think about how we want to allocate internally within that pool the best opportunities.
Briefly before I move on, because time is against us, do either of you have any considerable concern around the area of private credit, whether it's fully disclosed, whether it's robustly managed? Are you worried about anything in private credit? Briefly, Kim.
Look, I think markets are eternally optimistic, and they assume that the best outcome will happen, and we haven't had huge defaults in a long time, and so it'll be interesting to see when we actually do. I grew up in private credit at a time when there were really amazing workout people, and there's been no workouts to work out. So it'll be interesting to see what happens if we actually have defaults and whether the skills exist within these firms to manage through those situations. So I think there's a lot of just structural organizational things that'll be interesting in the private credit space.
When the tide goes out?
Yeah.
Edwin?
So we're in a default cycle right now. I think that's
rolling defaults, I feel like.
Yeah. I think most people are missing that. But if you take a look at watch lists are 10 times the size that were roughly 3 or 4 years ago. So we're in the middle of the cycle now. I think what it'll expose is who did good underwriting, who did bad underwriting. A lot of the, I shouldn't say a lot, there's definitely players in the space that were more chasing AUM than chasing great investments, and we have to see how that plays out. We've been involved in private credit for a very long period of time. We've bought a company called Antares out of GE. They have a sparkling underwriting record over a period of multi-decades. We think we're in good shape, but I think it'll be some players that don't fare as well as we work our way through.
In the best spirit of a short on-stage 20 minutes, you've got a minute each to give me a quick answer on deglobalization and the risk. Very, very briefly, does it enter your zeitgeist? Li Qiang in China this morning talked about a decoupling will lead to destructive spiral. To what extent, Kim, is global deglobalization something that you think about?
I think we do think about it quite a lot. I think a lot of the thoughts around, that underpin how we portfolio constructs assumes that everybody is trying to manage towards the lowest cost structure possible, and now that's different, right? It's also inflationary, so there's a lot that's going on that way, and it also increases the risk of wars, right, the more we decouple from each other. So all that creates risk that we haven't historically had to price in, or at least in the same way. So I think it definitely has an impact on how we will think about these markets, and I think it's going to be tricky because it's not going to be clear for a while.
Certainly, it might get even murkier if we go into 2025. To close, Edwin, your view.
Well, I think Kim alluded to it, but again, if you have deglobalization, you have the chance for some very bad outcomes and some very narrow regional spaces. The best way to protect yourself against that is to be well diversified across a number of investments, a number of different geographies, a number of different power blocks. We haven't seen that shoe drop in the sense that if you think about deglobalization and the costs imposed upon the system, it really should hit GDP. But we haven't seen huge revisions to GDP estimates going forward. And I think partly that's because global trade hasn't taken a hit right now. I mean, people talk about deglobalization, but if you take a look at trade stats aren't showing that as yet throughout the system.